Hello, my good people. Welcome back. Today, I want us to have a very candid conversation. But before I begin, let me introduce myself. My name is Timothy, and I'm with Pitt and Pitt Investors. At Pitt and Pitt Investors, which is a community-based company, we endeavor to educate our members and provide them with tools that will help them in their financial journey through training, through tools that we build, through education, and many other things that we feel will help people in their journey to financial literacy and also be in a better position to make better decisions in their financial journey. Now, today, I will not talk about any investments or anything to do with finance, but I want us to have a really candid conversation. And this centers on why do we in the first place invest? Because I know investing is hard. There's research to be done, there's learning to be done, and then there are all these terminologies that we don't seem to understand what they mean, and all these products in the market, and we don't know which are genuine, which are not, and then there's a chance I could lose my money. And all this can be very intimidating and sometimes makes us freeze and not be able to make any decision forward. But I think if we understand the real reason why we need to invest, or why in the first place do people invest, most of us know, investing in real estate, that's very familiar with us. We buy a property, it appreciates, we sell it, we make money, or we build some apartments and we get rent. So that's familiar, but when it comes to financial investments, we are a little bit scared about the whole process. But they're both the same. But the real question is not whether it's investing in financial markets or in real estate. The real question is, why in the first place do we invest? Why do we spend time, money, energy investing? And I think if we really truly understand the real reason behind it, may motivate us to invest even more. So if this is a topic that you love to hear and listen to, welcome. Karibu. There is one thing you own that you can never buy more of. Not money. You can earn more money. You can borrow it, inherit it, win it, be paid with it. Money is renewable. Time is not. Every morning you wake up with a little less of the only asset that never comes back. And most of us spend the best hours of it doing something we would not choose to do if we did not need to be paid. That is the whole problem. I want to argue that investing, properly understood, is not really about money at all. It is about time. It is the one mechanism ordinary people have for converting money, which is renewable, back into time, which is not. I want to lay the foundation before we can even talk about a single fund or a single share, because if the foundation is wrong, the rest of it is just gambling with extra steps. Let us start with something uncomfortable. You already have a business. It has one product, one customer, and one employee. The product is your hours. The customer is your employer or your clients. And the employee is you. That business has a fatal design flaw. Production stops the moment that employee stops. You get sick, revenue stops. You take leave, revenue stops. You get old, revenue stops. There is no inventory. There is no machine that runs overnight. Every shilling has to be fleshly cut from a block of your life. Now, this is not about criticism of work. Work is dignity. Work is where most of us find our craft and meaning to life. The problem is not that of work. The problem is that we have only one engine, and that engine is made of you. So here is the reframe I want you to hold for the rest of the episode. A job converts your time into money. An investment converts your money back to time. That is the loop. That is the entire machine. You sell hours to your employer, then you take part of what they pay you and buy assets with it. And those assets start returning hours to you. Not immediately, not all at once, but it returns them. And here is what money actually is. Once you see it that way, money is a store of labor. It is your past hours held in a form that does not spoil. When you spend it, you consume the hour. When you invest it, you send that hour out to go and work somewhere else. Maybe in a bank loan book, in a government road, in a factory machinery, and it comes back with company. The person who saves is preserving their past hours. The person who invests is putting them to work. You have decided to own something instead of consuming everything. What do you actually get? There are two answers. Each financial asset that has ever existed pays you in two ways or a blend of the two. The first is income. The asset hands you cash while you continue to own it. A bond pays you a coupon every 6 months and you still hold the bond. A money market fund accrues you daily and you still hold the units. A share pays you a dividend and you still hold the share. Nothing is sold, nothing is diminished. The tree gives fruits and remains a tree. The second is capital growth. The asset itself becomes worth more than you paid. You bought at 80, it is now worth 120. You have gained 40 shillings. But notice something important. You cannot eat it. To turn that gain into grocery, you must sell. And when you sell, you no longer own the asset. The tree gave you no fruit. The tree simply grew, and to realize the growth, you had to cut it down. Hold that distinction in your mind, because almost every mistake I see comes from confusing the two. Income is a stream, growth is a stock. Income is what an asset does. Growth is what an asset is worth. Income you can live on without shrinking the source. Growth you can only live on by consuming the source. Now, here is the part I most want you to take away from this episode. Most investors never get to it, and it changes everything. Capital growth is not an end in itself. It is deferred income. Ask yourself the simple question: why is a share worth anything at all? Why would a stranger pay you 120 shillings for a piece of paper? Not because the paper is pretty. They pay you because the share entitles them to a slice of everything that business will ever earn and distribute from that day until the end of its life. The price is nothing more than today's estimate of tomorrow's stream. That is all a valuation ever is. A guess about future earning discounted back to now. Very clear, I hope. So when the price of your share rises, what actually happened? One or two things. Either the market has revised upwards what it thinks this business will earn, the stream got bigger, or the market has simply become more excited, more willing to pay for the same stream. The mood got better. Financing financial investment sometimes it's more emotional and psychological than technical. The first kind of growth is real. It earns you power to increase. The second kind is borrowed from the future, and the future usually asks for it back, which gives us a hard test. and I want you to apply it to every single thing that you buy. Is there a plausible path that the asset will give me some income in the future? If yes, growth along the way is genuine. It is the market marking up a rising stream. If no, then you are not investing. You are holding a ticket and hoping someone else pays more for the ticket. That can work. It sometimes works spectacularly. But it's a different activity with a different risk profile, and it should be sized like one. The hierarchy is this. Capital growth serves earning power. Earning power serves income. Income serves time. Time serves the life you actually want. Growth is the caterpillar. Income is the butterfly. If it never becomes the butterfly, it was never the point. Now, enough of philosophical talk. Let us talk about what you can actually buy. If it is income you want, Kenya is unusually generous right now by global standards. Start with the money market funds. The average across the regulated field sits around 9% before tax, roughly 7.7 after 15% withholding tax. The stronger the fund, the more it pays. Your bank savings account, meanwhile, is paying you somewhere between 1 to 4%. That is the cost of leaving your money where it lands. So holding your money in current account or in savings account, you're losing a lot. Well, it could be in some money market fund somewhere. Now let's look at government bonds. You lock in a coupon for a fixed term and receive twice a year on a date you know in advance. Infrastructure bonds are worth singling out because their coupon is tax exempt. The headline rate is the rate you actually keep. And then the dividend payment from the Nairobi Security Exchange. The banks, the telcos, the manufacturer, they pay you cash for simply holding the share. The business underneath may grow as well. Here is what all means in shillings. 1 million shilling in a typical money market funds pays you about 6,300 a month after taxation. And that is indefinitely without you doing anything at all. Sit with that. 6,300 a month forever from one deposit. That could be a hospital bill. That could be transportation, maybe paying for your internet, electricity. It is not freedom, but it is a permanent recurring subtraction from the amount of your life you have to sell. And that is only what happens if you spend it. Leave it alone instead, and something else starts to happen. The interest buys more units. Those units earn more interest on their own. Next month, the fund is working with slightly more than it had last month, and the month after that slightly more. Let me show you what that is worth, because it is easy to nod at compounding and never feel it. Compounding is also known as the eighth wonder of the world. Suppose you save 20,000 shillings every month towards a target of 7.8 million. If your money earned nothing at all, that is, you put it in a tin under your bed, you will get there in 32 years. So putting in 20,000 every month to get to 7.8 million will get you in 32 years. If you put it in a vehicle, an instrument where it's earning 7.7% net, you will get there in about 16 years. That's the power of compounding interest. Compounding interest does not shave a bit of the plan, it halves it. Put it in another way. Over those 10 years, you would deposit 2.4 million shillings of your own. The fund would add roughly 1.2 million more. Half again as much, contributed by money you had already earned once. So run the arithmetic upwards. 15,000 a month A genuine second income for most households needs somewhere in the region of 7 to 8 million. 10,000 a month needs 15 to 16. Those are large numbers. I'm not going to pretend otherwise. But notice what has just happened. Freedom has stopped being a feeling. It is a number you can write on a page, divide by what you can save, and turn it into a date. That is what this whole frame gives you. Not riches, a date. I want to close this loop on why any of this matters. Nobody wants money, literally. I mean that literally. Nobody ever wanted a pile of papers or a number on a screen. What people want is what money holds at bay. They want not to be afraid when the hospital calls. They want to say no to a client who treats them badly. They want to take a job that pays less but means more to them. They want to be at school events. They want to write a book. They want to plant trees, start something, sit with their parent who is getting older. Every one of those is a purchase made in the currency of time. And passive income is the exchange rate. The sequence is this. You sell hours, you keep some of the proceeds, you convert some into assets. The assets produce income, and the income buys you back hours. Slowly at first, then as the income compounds and starts to buy more assets of its own faster. There is a threshold somewhere out ahead of you where your asset covers your life and work becomes something you choose rather than something you owe. Sadly, most people never reach it, but almost everybody could move meaningfully towards it, and every step towards it is worth something on its own. You do not have to arrive. Before I let go, 3 things so that nobody accuses me of selling a dream. 1. Inflation is a silent partner in every calculation. With inflation at around 6.5, a fund paying you 7.7 net is growing you actually purchasing power of barely a point. Always read your net of tax and net on inflation. That is the real number. Number 2, yields fall. The rates that look attractive today exist because of where the interest rate cycle happens to be. Central bank rates move and money market yields follow. Do not build a plan on the assumption that today's rate is permanent. And number 3, nothing here is free of risk. And especially when you invest in the stock market, it's a risk you're taking, and that's something you should be aware of. Government papers carry the government credit. Funds carry the manager's competence and the fees they charge. Shares carry the business. And that's why diversification is not a slogan. It is the acknowledgement that you will be wrong sometimes, but you will rather not be wrong about everything all at once. Here is a thought I want to leave you with. You are going to spend the next 10 years somewhere. That is not optional. The only question is whether at the end of those 10 years, you will still be cutting every shilling out of the fresh block of your own life, or whether some of your income has already quietly started arriving on its own while you sleep from the work that you did years ago. No, there's nothing magical about all this. The tools are ordinary. A fund, a bond, a share in a business that pays. There is nothing exotic about any of it. The unusual thing about this is by deciding that your time is worth buying back. Start where you are. Start with whatever you've got. Until then, guard your hours. Bye bye.